So now I'm going to start sharing my screen. All right, so here is our outline, and I put right here our week 13 outline. This is for December 1st. So there's our outline for today. I'm going to download it, bring it up on my machine, and then I'm going to share that document. I can, oops, just a minute. I got to open it. All right. So now you have this document. Hopefully, you've also downloaded it. Let me get the chat up here. Chat. More. Tell you what I'm going to do, just so we're all sure about this. I am also going to drop this in our chat box. So either one of those two places, you should be able to get the outline for today. So what we're going to do here is talk about our asset tracking. So here's the outline, asset tracking. We're going to talk about the project. Then we're going to go over a demonstration of a Colab code that you can use to help you make the choice for your projects. And then we're going to talk finally about the wealth module, which is part of the project that we're doing. So that's our outline for today. So we might as well get going. First off, and you're all wherever you're at today, but we have 3 sessions left, and that will be this Tuesday from 1:30 to 3. We'll also do a session from 1:30 to 3 on Thursday, and another session from 1:30 to 3 on next Tuesday. We will put the recordings of those sessions on our own online or on our online Zoom sessions. So there will be a link to those sessions there. So if you want to get them later on and look through them, you can do so on those sites. So that's our outline for today, or for the remaining sessions here. We've had a number of questions on the asset tracking, and I apologize for the confusion that might have caused. But here is the outline for our asset tracking. I want you to provide first the asset tracking thing. So put that at the very, very top. Also put your name on it as well. Then give me a brief discussion of the S&P 500 Treasury notes, and I would combine those, and I would emphasize the 10-year note. So, and then there's also the 1 year and the other notes as well. I would spend most of my time talking about what's happened to the 10-year rates, and then if you're looking at the other ones, any changes that you saw for the treasuries, if you've seen anything change in the yield curve over our semester, I would talk about it in that section. So, and if you didn't, that's fine too. And then finally talk about the VIX. So for each one of those, for items 2 through 4, you can do that in a paragraph. So start out with the asset tracking sheet, paragraph on the S&P 500, paragraph on treasury notes, paragraph on the VIX, and you can cover that pretty easily. You can, and again, you can do it in a paragraph. You can do it in more than a paragraph as well. The point of this project isn't to make this long, but to cover what has happened in a succinct and logical matter. I'm going to extend the deadline for this was originally due tonight. I'm going to give you till Wednesday at midnight to complete the project. So are there any questions on the asset tracking that you have at this point? Again, the asset tracking, and let me show you where you will submit it. I'm going to stop sharing this screen and now going to share our website. Let me get there. And here is our course outline. And you will go up here to the very top, go into the asset tracking, and you'll make the submission right here. So there is where you will make the submission. Questions at this point in time about the asset tracking? Enrique, is there anything else that I should be mentioning on the asset tracking?
No, I don't think so. One last thing, just to reinforce, you don't have to submit any Google Forms this week. Just so don't worry about it. Though on the Excel sheet, there's the 20th that you should be able to put there and upload with that as well, the last date. Okay, but that's it.
Yep. So yes, and again, just coming to our sheet. Let's see here. We'll have this asset tracking sheet. You should have it filled out till the end here, 11/20. So up to this point, last Friday was the last, or 2 Fridays ago now would be the last entry that you have to make. So one question here. So the 2.5 page isn't really necessary to, no, not really. That's more of a guideline, all right? If you're getting way over it, you're probably getting way too long. If you're severely under, if you're under 1.5 pages, you're probably not doing it thoroughly enough, because if you consider this is going to be 1/2 page, and then each one of those paragraphs would take about 1/2 page as well. If you're getting close to less than that, you're probably not doing it that well. If you're on 5 pages, single spaced, you're putting way too much material in there. Okay. So does that help understand sort of the guideline that we're looking for here, hopefully? Do we need to cite sources? So I would suggest that you do cite a few sources. You could use the sources from those that I posted. A couple would be good, and I would just say that you would want those to be cited so that I can find them. It isn't necessarily, I don't have a set format for citations. If you want to use what I did throughout the semester, that would be a very appropriate way of doing it as well. So, other questions here on the asset tracking?
I have a quick question.
Sure, go ahead.
So just to confirm, so you would want us to kind of just screenshot the kind of the Excel sheet that we had and put that into the Google Doc at the top, and then just kind of evaluate that at the bottom.
Yep. So you're gonna copy this into Excel sheet. All right. Copy it onto your Word. Paste as a picture. I would suggest pasting as a picture. There you have it. Then you're going to tell me what the movement of the S&P 500 was and some of the major items that impacted that during the semester. One paragraph. So you can think about this as having a section here. Let me get here. Some reason my cursor isn't around. Huh. What's going on? So I would suggest having, let me do this. All right, yeah, now I did it. So I would suggest having this at the top, your name here, then a section on S&P 500. Tell me what happened during the semester and the major news events. Then I would have another section on treasuries. I would focus on this 10-year note. Tell me what has happened to the treasury yield during the semester and some of the impacts that it's had. In the meantime, you might also mention if anything significant happened to the yield curve that you see here, 1 month, 1 year, and 10-year note. Then finally, you would have a section on VIX, all right, and what has happened to the VIX during the semester. Each one of those is a paragraph, and you might put more than one paragraph in each one of those, okay? Other questions here about what we're looking at?
I have a question. So I already turned it in and I attached just like the full Excel sheet of the asset tracking as well as like a separate document of.
That's fine. That's fine. That's fine.
Okay. And since I already turned it in and I know somebody mentioned like citing stuff, I didn't cite anything. So is that like?
Tell you what, if you want to cite some things and resubmit it, that'd be fine. Okay. Without looking at it, I would suggest putting a couple of citations in, 1 or 2. Okay.
Okay. Thanks.
Yep. And just resubmit it. And if you resubmit it, we'll grade the last one.
Okay. Cool. Thank you.
Other questions here? All right. So that is anything, any other question here? Appreciate any questions. Anything that we can answer, let's do so now. I'm gonna eliminate this, cancel this. I'm gonna stop sharing, and I'm now going to go back and share my outline with you so that we got that. All right, we should be back on the outline. All right, final. Here's our final. Multiple choice and short answer. There's only going to be one section of it. You will have a 2-hour time period to complete it during finals week. It will be cumulative, but the emphasis will be on the last part of the course. So we can ask any questions that you would like that happen during the course, but expect it to be more focused on the last part of the course. So again, there will not be 2 parts to it. There will only be 1 part to it, and that will be a multiple choice and short answer part. we will make that available at the beginning of the finals week, and you will have till the end of the finals week to complete it. So, and expect 25 questions on that midterm. Questions on the midterm at this point, or the final. Hey, we're getting to the end of this semester. It's hard to believe. Only 4. How many football games have we played this year? 4 football games, and we should be over, and this should be the week of the Big Ten championship, but we're not there. So, but that's the final. That will happen. That will begin next Thursday, and again, you will have till the end of the semester or the end of the finals week to complete that. Okay, if there any questions on the final?
How would you suggest kind of is the best way to kind of prep for the final?
Yeah, so I would do, I would look over the old midterms first, because the questions that we asked on the midterms are the ones obviously we thought were important on the midterms. So you're not going to see too many questions from the first part of the course stray from the midterms. The latter part of the course expects a question on the wealth model. Expect some questions on what you're doing when you're putting 2 different types of assets together in a portfolio. And we will really hit that home, and I'll make sure that we hit that home on the Thursday section and next Tuesday as well. So for the final part of the course, I will put together a little outline that we can use to make sure that you can prepare well for that final. So, but I would look over the two. Can you now having said that, Henrique, can they look at the midterms?
I think they can. I'm gonna make sure right now, but I think they could. Otherwise, we can leave it open if it's not right now.
Yeah, we'll make sure that those are open. And I just realized I didn't know if they were open, but we will make sure that those are open. And again, I would suggest looking at those 2. And honestly, they're brush up on a couple of the modules that I always ask questions about. Portfolio model will be important. Annualizing data and risk and return measures will always be important. Looking at the stock and the bond fund characteristic sheets would be important as well. Other questions? I hope that helps. If other questions on the final here. All right, good. If you got any questions, let me know. All right, the project. If you get it to me Friday at midnight, I will provide a review to you. And at that point in time, I'll tell you if you do these things, you do the things I tell you to do, complete it, you should be looking at a very good grade on that project. You will have until Friday at midnight. I'm going to show you again where really would like you to submit it through a Compass, because I lose things if we don't do it through Compass. Let me show you where I want you to submit it. Go into this project, submit it for review here. Okay. You do not have to submit it to me for review, but if you submit it, I will provide you a review, and I think that would be very useful as you prepare for the final part of it. If it's not done and you want to look at the first few parts, I will give you comments on those first few parts as well. So that's the final project. Again, if you want me to review it, submit it here on this website. All right, I'm going to go to the course outline now, still talking about the final project. And if you go down to this Project 2020 example doc and pull it up, I'm going to download it now. And I'm going to share that screen with you. Again, you have this document on the website. And I'll just make it as easy as I can. I'm going to drop it in our chat box as well so that everybody has it that wants it. So there you have it. And I provided an example of a completed project. All right, so, and I did this with our Vanguard 500 Index Fund and our Vanguard Long-Term Treasury Fund. And this is why I asked you not to use those two funds, all right? So what this project is going to look like is first you're going to give me an asset description part of it. And that is, and again, you are going to choose at least two. You can choose more. And there are reasons why you would want to choose more. Obviously, the more you choose, the longer your descriptions will be for each one of the items that you are including here. So I, again, chose the Vanguard 500 Index Fund, the Vanguard Long-Term Treasury Fund, all right? And by the way, you can find other funds that very much look like this. So Vanguard 500 Index Fund, you're going to tell me some things about if it's a mutual fund. And by the way, you could choose a stock. There's nothing that says you can't choose a stock. You can choose specific investments. It's up to you. For this Vanguard 500 Index Fund, what you're going to do, though, if you choose a mutual fund, you're going to tell me for a mutual fund, is it actively managed, or does it follow the an index? If it's actively managed, you will want to tell me what the goal of the fund is, all right? So you'll want to tell me what the goal of the fund is. Obviously, if we're looking at the Vanguard 500, it's an index fund. It's not actively managed. Its performance will closely match the S&P 500. Then you can list specific characteristics of the fund are management, it's active, passive. This could be, you could call it index. If this was an actively managed fund, you would want to tell me what the active management is. You would tell the investment goal. This one is to follow the S&P 500. You would want to tell me the types of stocks it is included. In the S&P 500 would be a blend, contains both growth and value stocks. It typically is large capital stocks. You would want to give me the expense ratio, portfolio turnover, and I just included here the 10 largest holdings, which in this case is obviously the 10 largest large cap stocks in the fund. By the way, that will often tell you a lot about how this fund is going to react. The S&P 500 is dominated by Apple, Microsoft, Amazon, Facebook, Alphabet. So we have 1, 2, 3, 4, 5. 5 of our largest stocks are tech companies. Then we got Berkshire Hathaway in there, Johnson & Johnson, Procter & Gamble, and Visa. Just gives you a feel for what's in the fund. Then you will describe, then I described it, the long-term index fund here, our treasury fund. Again, you could choose a corporate fund, you could choose any one of a number of funds. So it will follow, again, long-term treasury returns, and it is an index fund. You will again give the investment goal. Expense ratio, types of bonds, treasury. Duration, I would suggest giving me the duration and credit quality if it's a bond fund. So duration, I would like to, that's obviously very important. I know by looking at this duration that I'm going to be very interest rate sensitive because it's a long duration fund. Credit quality, no default risk, inflation protection, tax exemption, no. All right. So those are the types of things. And again, coming back, if I know those things, I can tell you a lot about what the yields would look like for that fund, etc. So you can see here, this is the sort of thing I'm looking for in your description. All right, questions or comments here as we're going through. So you're going to have an asset description section, and you're going to list these items for each one of the assets that are in your fund. You will then give me some historical return, standard deviation, and correlation coefficient. And I really do want to know what those correlation coefficients look like. And here for mine, I had a 10 point, and also tell me what the period is. The longer the period, the better we are. And so this one covers from May 19th, 1986 to November 3rd, 2020. And then we give the means for both of these standard deviations. I listed the coefficient of variation. And then tell me what the correlation coefficient is.
Logged in on your Zoom, so you're in my class. It says True Rajesh. It's my class. This is a class.
Turn off your mic.
All right. All right. All right. So then you get your correlation coefficient. If you want to, you might want to just I included and attached to this is the Project 2020 XLSX worksheet, which shows the returns and calculations to it. All right, so you're just going to give me that. By the way, I like getting these on a comparable period, which is why I typically don't use the returns from the prospectus, because I like to have them evenly matched. Because, for example, if I just included the last 5-year returns for VFINX and 30 years for VUSTX, it wouldn't be a comparable because they're not over the same time period. All right. So that's what we want you to do. Then you're going to do an EV frontier, and you can use the 2-period model that you've used before. I wrote these as calculations here. And we'll come back to this when we're talking about the wealth model here in a little bit, but I just calculated the EV frontier. If you're looking at the EV frontier, you would never hold all your assets in VUSTX because I can increase the return, reduce the standard deviation, get more risk efficient by holding at least 25% in this asset. So that just gives you a feel here. Then you're going to tell me what your split is. So you've chosen 2 assets. You're going to tell me I'm choosing 75% of my assets in VFINX or my Vanguard 500 fund, 25% in my VUSTX, and then you're going to tell me what that return and standard deviation is. Okay, and those can come directly from here, right? Same return. And you're going to tell me why you chose that fund. Right? And here, this is very individualistic, and I would encourage you. I listed here that I chose this because this is sort of Boggle's suggestions. Held 75% in VFINX, 25% VUSDX. You could hold a much higher. You could hold anything, but justify why you decided that level. And the justification doesn't have to be long, but if you might say, I want a 100% VFINX, it might be, I am young and I want to get as much return as I possibly can. Okay. And by the way, so if you're young and not very risk averse, you might be choosing a fund that is much more risky than this fund here. You could even choose to have 2 stock mutual funds, S&P 500 and maybe a mutual fund that's mid-cap growth, and use those 2 funds. You could combine it with 3 funds, S&P 500, treasury fund, and also a mid-cap growth. So you got a number of options here. All right. So we want those things done. And then, all right, questions. I'm going, so there's that suggestion. Then I'm going to go to our final 2 sections here. Questions or comments so far? Just give you a minute or a couple before I go talk about the next 2 sections. Hearing none. Going once, going twice.
I had a question.
Sure, go ahead.
So for the EV Frontier model, for the risk-free rate, where do we need to find that? So like, is that like the 40-year treasury rate then, or what is that?
So here, all right, if you want to know what I would be using something like a 10-year. 40 years, you're getting so few trades. I would be using something like the 10-year note.
Okay, thank you.
But which means you can't, yeah. If you hold it, yeah. Other questions? Good question. All right. You are going to also do this expected wealth level and value at risk, and that's from our wealth module. And you're going to put that in here. I am going to be looking for this for a reasonable number. All right. And by a reasonable number, this should be something, if we're putting $400 in here, it should be something like $2.4 million to 1.9, 1.8, 3, and I'll pretty much know, what this model is going to say. So this needs to be sort of reasonable given the portfolio that you've chosen. And we'll talk about that when we go over the wealth module in a bit. Again, what I want you to do is with this wealth module, get a feel for what your expected wealth level will be at the end of this period, and then also the potential downside that exists here. Again, we'll talk about that here in a minute, and we'll come back and talk about this wealth model. It'll be very easy to do, so, pretty straightforward. All right. And if you start out $400 and make 75, you could have $2.4 million, which would be a nice retirement. Okay. We'll talk about what these 5% and 10% value at risk mean as well. And then the final section, list me what your concerns and risk are with your portfolio. For mine, I listed that, 2008 or a repeat of the depression years 29 through 35, which I don't remember, just so we all know. But if we have something like that, we would have very bad returns, and then we could be much lower than our expected wealth levels. I want you to think about some of the risks that are out there as far as this portfolio. So that's what the project should look like. Questions or comments on the project?
So I know you said that we couldn't use like the exact VUSDX fund that you use, but can we use another like S&P 500
Yep.
or long-term treasury?
Yep. Yes, you can. Yes, you can. Just, yeah. Spartan 500, for example, would be very much the same as Vanguard 500. All right. And you could use a Vanguard short intermediate term fund, or Spartan or Fidelity or anybody has a long-term treasury fund as well. Yes, you can use very similar funds to what I've done here. Other questions? All right. I would suggest taking this seriously because, again, it will guide you in what you can make as in your investments. Let's say the other thing that could happen is next year you could be also in a retirement plan at your work that is self-directed, and you would then have a number of alternatives to choose from. You would now know how to look at those returns and sort of make a choice amongst those returns or those alternative investments as you make your return or your asset allocations. Questions here? All right. That's the project. Straightforward, I hope. It'll take a little bit of work, a little bit of thinking. I think you'll find it's useful, though. All right. I'm going to stop sharing my screen now, and I'm going to turn this over to Enrique. I got to make, can you take the control, or do I have to?
No, I think I can.
All right.
All right, let me share my screen here. Hopefully you guys can see that. I'm stopping. You didn't make that. Can you guys see my screen? Let me put up the chat.
Yeah, I can see it.
Okay, cool. So.
You might want to show how to get there, by the way.
Oh yeah, definitely. So I'm back to on the outline here. I'm gonna upload that right after. But either here or if you go to Compass on projects, same place that we have the wealth model, we have here also a module, a collab model that will might help you in getting the EV frontier and the portfolio or choice. Okay, so there are some instructions here, and I'm gonna go over that right now. So you don't have to use it just before moving on, but I think you might find that this very helpful in getting your project done. Okay, so in order to get there, you just click on the link, and again, I'm gonna put that on the outline as well. And then I'm gonna go over the code real quick. It's not difficult at all. But first things first, what we're gonna be needing to do is the same thing on the wealth model. You won't be able to use this particular code. So once you got to that point, you should click here in File and then save a copy in Drive. And you're gonna have to be logged in a Google account, or I think the university account linked to Google somehow that you can do that. And then you're gonna make yourself a copy of this code. Okay, so you're gonna see here copy of ACE 444 and the exactly same code, but now you can run it. Okay. So what does this code do, right? Basically, you have two inputs, or let's say 3 or up to 5 or 6 here, depend inputs that you have to do here. First of all, you're gonna choose a starting date for your analysis. So let me do, I don't know, 86 first, or January 1st. You're gonna pick a risk-free level, risk-free rate here. And again, you can assume that you're looking at the 10-year note, as Gary said, or you can assume something else. This is the starting date and the risk-free rate that is gonna be using to download data from Yahoo Finance, calculate returns, standard deviations, correlation matrix, and derive the EV frontier for you as well, okay? So after doing that, something else that you're gonna be doing, and we limited that to 5 assets, but we might leave up to 10 assets for you guys to play with. You should be able to put here the ticker of the asset, the asset. So if you go to Yahoo Finance, let me put the Vanguard. Let's say you want this fund over here, okay? So the symbol is the ticker, VOO is what you should be putting over here, okay? So all cap like that. I'm gonna leave the other one for now, just to run once. So I'm gonna put one asset, which is the asset that Gary picked for the S&P 500 index fund. This is the bond fund. And if you are done with the assets, you just want to just put the same assets over and over. Make sure that you fill that all, okay? Once you do that, you just have to go here in runtime and put in run all, okay? The model will start running itself. You're gonna see that cells running. It shouldn't take like 1 minute. It's supposed to be very fast, depending on how much assets you have and the period of time that you're using. But once you do that, it's gonna give you some outputs that might be helpful for you. So for instance, over here, it says that it downloaded the 2 assets prices that you picked. It's showing here the returns, the standard deviation on each asset, as well as the Sharpe ratio and the betas as well. Okay, this beta is calculated based on daily data during all sample, so all period that it downloaded the data. So it might be a little bit different than Yahoo Finance. I think Yahoo Finance uses a monthly data and only 5 years. Okay, now so this is just from the beginning. You will plot as well this correlation matrix among those assets. So you can see that the S&P 500 is 1 correlated with itself, but negative 0.2 with the bond fund, right? The very important thing here, and this will print out for you, is when does the analysis start? And I'm gonna do an example in a minute, but if you put an asset that, for instance, was created in 2005, the data will be standardized in 2005 onward. So even though you put like 1990 there, if there is an asset that is newer than that, the code will always like make everyone comparable using the newest asset, okay? So you gotta just be careful, I would say, by not putting a fund that is, I don't know, 4 months old, and then you're looking at returns of all the other assets just from 4 months, okay? So this will tell you that, and you should be able to look at that and just make the call if that's okay or not, right? Moreover, it will here print what would be the portfolio and its EV frontier that would maximize the Sharpe ratio, okay? So In this case, if you hold 66% on the bond fund and 33% on the S&P 500 fund, it will give you here the highest Sharpe ratio with a portfolio expected returns of 8.7% a year and an expected standard deviation of 8.5. This is all annualized, okay? I forgot to say that, but those and those other ones are annualized already for you, okay? So with that, you have already the EV frontier plotted, and this is the max Sharpe ratio portfolio here with those weights, okay? If you go a little bit down, you're gonna see a breakdown of the portfolio that you chose, or this is the max Sharpe ratio portfolio, sorry, for you. If you wanna go down here and you wanna change that, that's up to you, but you can put how much money you have and just hit play on the single cell and it'll tell you how much shares you should buy of each asset. And finally, so let me just backtrack a little bit here and make sure that so far you guys are good. Any questions or comments here on how it's run or how it's done, or any questions? Okay, assuming that everyone is good then, right? All right, so I'm gonna back a little bit and just, so how do we find the risk-free rate? I'm assuming there's 2% here. You can use a 10-year note or even 30 if you think that you're gonna hold this portfolio for 30, but that would be, I think, a good benchmark. I think Gary mentioned that. You can look at the 10-year note yield and use that. So it's probably gonna be like 75% maybe, or this is 0.75%, right? So it's very low, but
Yeah.
you can make your call and look at the 10-year note yield, for instance, okay? And you can come over here and add stocks or other funds as well that, of course, are available on Yahoo Finance. So let me put here, for instance, Apple. Let me do a fund of commodity. I don't even know one, but okay, this commodity indexed trust, I don't even know what it is, but GSG, and I think this is, it's gold, this other one. I'm just picking random here, gold, yeah. Just to demonstrate that if you change something here on the module, you're gonna have again to run time and run it all again, okay? Just make sure that you have the correct, you didn't miss anything. So it's just better to do that. And I'm gonna illustrate that right now. Like, so now we have 5 assets. You have each asset individual annualized returns and standard deviations and Sharpe ratio, betas as well, the correlation matrix that you can use, you know, to describe why you pick those or not. And now important, the assumption that I just talked about, even though we had here data starting in 1986, because one of those funds, I would guess is commodity one or gold, I don't know, starts in 2006, all the module is considering data or prices and therefore returns, correlations, and standard deviations from this date, so 2006 up to nowadays. So that's what, 14 days? You might be good with that, but the problem will be if you pick a fund that is nearly 1 year old, for instance. Okay, so make sure that you look at that and make sense of the data that you have presented here. But other than that, you should print the same thing with more assets, right? You have all those assets. Now for the max Sharpe ratio, the weights here supposed to be 56, nearly 57% on the bond fund, 33% on Apple, and 10% on gold, this gold fund. That would provide you an expected return of 16% a year and an expected standard deviation of 11% a year. So I think now you guys are kind of like seeing what it does. It might help you with deriving the EV frontier and helping picking the portfolio. So you can come back and play, okay, let me kick this guy out because the returns are negative, right? So I'm gonna put Amazon here as well. So you can come runtime, run all, and play a little bit with that. And I think I will like make it 10 assets long, so you guys can play with that and see how it looks like now. Different, right? Story here with Amazon and Apple. You see that even though the greatest part of that is on the bond fund, I guess because of the low correlation with the others. But you have here now a different portfolio of your selection. Again, this is the max Sharpe ratio portfolio. And here, how much money you have, how many shares you should buy of each one. Now, finally, one last thing that you can use that's optional, okay, is on this session here, you can pick a level of return, and let's say you won 17% a year of return. Now you can hit play over here. You will calculate a portfolio with those assets that will give you 17% return a year with the minimum level of variance or volatility based here on the optimization, based on the correlation between assets that you can possibly have. And those will be printed here on weights 2. So even though you run the EV frontier and you know that the Sharpe ratio is here, maybe you are super, or you want more risk, and that's nothing preventing you from going here and saying, okay, I want 25% return a year. Now your portfolio is up here, your weights are a little bit different, so you see that way more weight on Amazon and Apple, still a little bit on the bonds. Now, how you just gotta, let's say, own your assumptions, I would say here, because you are assuming that the portfolio will perform like that over the next years, right? So Amazon and Apple will perform like above 30% a year. That's a very good return. So this is, again, mathematic, and your assumptions is what is gonna give you a good module or not. So remember, garbage in, garbage out. If you put Tesla here, it's gonna be probably like a very big return if you are analyzing a small period of time. So you gotta be able to look at that and make sense of that. But the good thing is you can always come back and say, okay, let's say, okay, now I'm gonna put a, I don't know, this is NASDAQ, I think, fund, or it's QQQ, I always forget. And I will take Apple out, and I'm gonna put, I don't know, Ford or Spotify, I don't even know the Walmart. Again, runtime, run all, and if you put the tickers right, downloaded 5 of them, you produce the output again with different assets here. And you see that the last one didn't run. That's probably because you were trying to achieve a super higher level of return that is highest than all of them together. So, yep, the maximum return that you can have is 14%, because it's the highest return asset. So you gotta lay in between those. So I think that's it. It's supposed to be, again, super simple, but it will give you some, I think, nice outputs and readily outputs that you can use on your project. So you can paste those graphs, you can use those tables. So feel free to use it. Just remember, once you got the code, you click on the link. First thing that you gotta do is create a copy on a drive, file, save a copy drive, and then you can just runtime, run all by changing those assumptions here. Any questions here or comments on the module or the EV frontier, or how to use that on the project or. Okay, so Gary, I don't know if you have a comment on the or
yeah, I would just say what I like about, and you can choose to either use or not to use this mod. You can use the old way we've done it, and Enrique's put this together, and I really like this for a number of reasons. The big one is that, all right, go back and just put our two module, just
Yep.
put VFINX here.
So remember, if you guys don't want like the 5 assets, you pick 2 or 1 and put the same ones. What is the starting date, Gary, that you want?
Yeah, let's just stay there. That's fine.
All right.
Let me do one other thing. I'm Vanguard mid cap. And I'm just going to put in here, I'm looking for a mid cap fund.
And again, this last one is not running because the maximum return that you can have is 10.3. That's why it's telling you can't have more return than that.
All right. So, all right. Now go here. So far, yeah. What we're finding here is, go down a little bit. Are we still running? Go down just a little more, Enrique.
No.
Yeah, there you go. Now, let's say you're thinking about adding VIMSX. And just put that in there, VIMSX. Now, what
VIMSS?
SX. X.
Okay.
All right, runner now. Now, just think how long is what I've just done is added a mid-cap growth to this. Oops. There we go. All right. So you can see here, that one has a higher return than my other fund. It has a 0.94 correlation, and you can see what the Sharpe ratio is. But if you start out with your fund and want to think about adding some funds to this is a lot faster and a lot easier than doing it through the Excel framework. So Enrique just put this together, and I really like this. And this is something that, as you're getting out into the profession, things like this will be available to you, and you can add it and see what another fund would do to your portfolio choices. So there we go. Very nice.
All right. So just with that. Okay, I will stop sharing and giving it back to you.
All right. Let me start sharing my screen again. Let me get let me get here. Share screen. So I have a question here. I'm going to launch a poll. I'm going to talk about our wealth module now. Answer my poll here. I want to know, have you heard about value at risk? So just tell me. I'm just curious. All right. So we had 88% of you said no. One of you had it in another class. So let me just go over what value at risk is. I'm going to talk about the wealth model, and I'm going to go through it. Stop sharing. Let me get rid of this. Here's our wealth matter module and what is value at risk. And I would suggest, if you want to, go to the Wikipedia article on value at risk. It's actually very good. Value at risk is a risk measure. It's used a lot in regulations. And let me just describe what value at risk is. And I'm using this graph here, which comes from our Wikipedia article. But let's say I choose a 5% value at risk, and I have this hypothetical profit and loss function. And if I'm choosing a 5% value at risk, what I'm finding here in this example is this tail here. And the 5% value at risk is this number right here. And in our case, it's minus 0.82. And what it gives is the 5% of the probability here in the tail. So at minus 0.82, we have 5% of the values that can be less than that, okay? So here's how you use value at risk. So we pick a value, 5% value at risk, and then you determine the level of return that causes 5% of the observations to fall below it. We do that in the wealth module for you, but let's say that 5% value at risk is $60,000. What that means is that given our model, historical observations, what have you, that 5% of the time your wealth will be less than $60,000. All right. You want that number to be as high as possible. The higher it is, the less risk you have. Okay. So here at this level, 5% of the time you will be less than $60,000. It could be $0, it could be a minus $1,000, but 5% of the time you'll be less than that. Again, higher levels are better. All right. Now, that's the definition of value at risk. And now I am going to go to our wealth model. So I'm going to stop sharing this and go back to my Safari. Safari, there you go. Share it. And now I'm going to go to our course outline. And if you go here, go to this site, you will go to the wealth model. We have a video here that describes it, how to run it. And then we have another video here that describes the interpretation of it. And I am just going to go through it here today. So let's go to the value link to the wealth model. Here's what Enrique just showed us, our optimization model. But let's go to our wealth model. And here it is. Oops. All right. We are here. And this is what you will see. And what you do here is you enter these inputs and it will calculate expected wealth levels, 5% value at risk, and 10% value at risk here. I am going to do this for a very specific case here. And let me get that case up here. I'm going to show you. Let me pull this up here. All right, and I'm going to stop sharing my screen again and share my whole desktop now. All right, here's our wealth model. And what I'm going to do here is show you how to use this. And this, you should recognize this as coming from my project, the example project that I submitted before. 0% risk. I have a 0% weight on S&P 500. I have a 7.87% return, 10.76% standard deviation. I go up to 1% or 100%. I have 10.06, 18.58 standard deviation. All right. My name's Gary Schnitke. I have 40 years. I am going to do, I asked us to look at $400, and I am going to start here at the bottom. And I put 8.842 in here. Oh, by the way, why I'm starting at 0.25 and not 0 is if I got the 0.25, I would never invest 0 in VFNIX, because it has a lower return and higher risk. Standard deviation is higher. I would start here. And so I'm going to enter that here, 0.0849 and 0.0849, 0842, 0849. And this number of iterations. All right, what this model is a random stochastic Monte Carlo model. What that means is that the numbers are going to change a little bit each time because we use random returns in calculating items. The higher this number, the more accurate, quote unquote, the numbers will be, but the longer it will take. And I'm just gonna, so let me just give you, I'm gonna hit 10,000 and hit return here. And you can see here, it's going to take a little bit of time to think. And if I had put this at 100,000, it would take much longer to think. All right. But the bigger the number here, the more accurate it will be, in the sense that it won't change much from one run to the other. I'm just going to do this for 10,000 iterations. And it's going to take a little bit of time to think and go through this. And again, we're running this. This is a Python code where we're going through and doing 100,000 iterations of returns for the next 40 years monthly. So it's sort of a big model, but I'll show you the code here in a little bit for doing that. What you need to do is for your selected portfolio is calculate the expected return for after in 2060, after 40 years. So what we're doing here is calculating the return that if you made an investment of $400 each month, you had a portfolio that had an expected return of 8.42%. That's obviously annualized. Its standard deviation is 8.49%. We are going to give you a feel for what that return will look like. We'll give you a graph. And then I'm just going to pull out 2030. So in 2030, if you made that those investments, you would have 74,090, and you're 5% up. And I got to format cell number, no space. So we would have, I'm just copying over here, 74,090. and our 5% value at risk is 55,406. All right. So in 10 years, if I made that investment, my expected most likely is 74,090, and my 5% value at risk is 55,406. So 5% of the time, I would expect to be below 55,406. Let me just go down here to 2060, and I'll write in here what our wealth level is after those years, and also my my 5% value risk. So I would expect to have $1.4 million. 608, and 5% of the time I would have less than $680,000. All right. So all right. That gives you a feel for your expected return and your risk. I'm going to take an extreme example here. All right, we've put our expected standard deviation in here at 0.08949. I'm going to lower it to 0.01. So what I'm saying here, and I'm going to hit return so we get it going. All right, so I've left my expected return the same and lowered my standard deviation. What that is going to do is leave my EV roughly the same, but it's going to raise, much raise my 5% VAR. So we're watching it calculate, and it's going to raise that number quite a lot. Okay, and it's still thinking here. And it'll take a little bit. I should have knocked it down to $100,000, 10,000 rather than 100,000. Again, what we want you to do is put in your expected return here and your standard deviation. And again, I would be, at least at the beginning, doing these at 10,000. And maybe for your final run, do 100,000, because you can see here that it takes quite a bit of time to do this. But let's go to 2030 now, and look what happened. We have roughly the same expected return, 74,148, but look at my 5% value at risk. It's now 71,000. So that says that my returns are getting very much more closer to my expected mean. Okay. One of the things that I did, rather than wait for this all, is I did these for all of my returns here. And I did it in 2030 and I did it in 2060. Now look, as I increased the expected return on my portfolio, I increased my EV frontier. Okay. Went up, went up, went up, went up. My 5% value at risk went down. So I'm taking more risk to get this higher return, which is what you would expect. But this, so after 5 years, after 40 years, 5% of the time I would have less than $441,000. You can see here, it seems to make less of a difference in 10 years. Again, we'll talk about this next time, about using this and why a number of people say to lower the risk as you get older. All right, I'm going to stop here right now. I forgot to share my video, not that it matters all that much. Questions or comments at this point in time before we close for today? You have asset tracking due Wednesday. We will be back here next Thursday from 1:30 to 3. You don't catch it, I'm going to put this material up on the web here shortly. Anything for the good of the order up to this point? If not, we will see you soon. Have a good rest of your week. All right, Brian. Yes. How do I shrink my work from the Excel sheet? Copy it as a picture and then grab the corner and pull it up. Does that help, Brian? Let me know. Or that you grab the corner and then you pull it up. So you got to paste it as a picture. Make sure you paste it as a picture. No, unfortunately, I have an Apple machine, but see, I would do, and I'm not sharing this anymore. I'm going to share my screen. I'll show you. So I would put this here and I would go home. And you could either you might just do this as copy as a picture right here. I know this works on, and then you would go, then it's going to ask you that question as shown on screen, just say, okay. Then come over to your Word file. There it is. Grab this little corner here. You can make it any size you want. There you go. All right. Any other questions, comments here? All right. We will see you all Thursday. If you got any questions, let us know. Talk to you later. See you later, Enrique.
Do you want to talk in a bit?
I can't today. You want to do it tomorrow? I got another meeting that got backed up. I'm sorry.
No, that's fine.
What
Yeah, tomorrow morning or
Yeah, what time tomorrow morning would be good for you?
after like 10 maybe?
How about 11?
I mean, I can double check and send you an email in a few.
Yep.
All right, thanks.
Mm.